All right, let's talk about something that's basically the universal language of business, financial reporting. It's how you figure out if a company's a total rock star or, well, a sinking ship. And by the time we're done here, you're going to have a much better idea of how to read that story for yourself.
So, how can you really tell if a company is winning or losing? It's like the million-dollar question, right? It doesn't matter if you're thinking about investing or you work there or you're just plain curious, you need a way to check its pulse. And that's exactly what financial reporting does. It's the official scorecard, plain and simple. Okay, but here's the thing. For that scorecard to mean anything, everyone has to be playing by the same rules. I mean, you can't have one company just making up points and another one, I don't know, moving the goalposts whenever they feel like it. It would be chaos. That's exactly why we have this sort of financial constitution.
And look, this isn't some dusty old rule book nobody looks at. It's a really smart, coherent system that gives us stability and, most importantly, trust. Its whole job is to stop what's called firefighting, which is basically just making up rules as you go along to solve a new problem. That would be a mess. This framework makes sure the numbers you're looking at are consistent, so you can actually compare one company to another.
Now, most of the world uses what's called a principles-based approach. Think of it like this. Instead of a giant book with a specific rule for every single tiny situation, it focuses on the spirit of the rule, the why behind it. The thinking is that it's actually harder to find clever loopholes when you have to justify the economic reality of what you're doing. It really puts the pressure on accountants to use their professional judgment to show what's really going on. Okay, so we've got the rules of the game down. Now let's dive into the actual building blocks, starting with the first big one. Assets. And to make this a little more concrete, let's invent a company for us to use. We'll call it Explainer Co. So what does Explainer Co. actually own?
First up, we've got property, plant, and equipment, or PPE. These are the real physical workhorses of a business. We're talking buildings, machinery, vehicles, you get the idea. So if our Explainer Co. goes out and buys a new office building or a fleet of delivery vans, boom, that's classic PPE. The big thing to remember is that it's a long-term physical asset they're going to use for more than a year to make money.
Now, this is where it gets interesting. Companies have a choice here. They can use the cost model, which is pretty straightforward. You just stick with the original price and then reduce its value over time as it gets used up. That's depreciation. Or they can go with the revaluation model, where they update the asset's value to what it's worth in the market today. But, and this is a big but, you can't just cherry pick. If you decide to revalue one building, you have to revalue all your buildings. It keeps things fair and consistent.
But of course, not everything a company owns is something you can, kick the tires on. Some of the most valuable assets out there are things you can't even see or touch. We're talking about intangible assets. Think about a secret formula or a world-famous logo.
And these come in all shapes and sizes. You've got patents to protect inventions, copyrights for things like software or books, and trademarks to protect a brand name. Then there's this weird one called goodwill. It's basically the extra money you pay for a company above the value of its physical stuff for things like its reputation or customer base. Super valuable, but you can't put any of it in a warehouse.
Okay, but here's a super important rule you have to know. Our company, Explainer Co., can't just wake up one day and say, hey, our brand is awesome, let's say it's worth $1 billion, and then just slap that number on its books. Why not? Well, because who's to say? It's way too subjective to measure reliably. So, as a general rule, you can only put an intangible asset like a brand on your books if you've actually bought it from someone else.
All right, so that's the stuff a company owns. But what about the other side of the equation? Let's flip the coin and talk about liabilities, basically what a company owes.
Let's jump back to our friends at Explainer Co. for a second. Imagine they sold a product that turned out to be faulty, and now, they're getting sued. Okay, so the sale itself is the past event. The lawsuit creates this present obligation. Now, if it looks probable that they're going to have to pay up, and they can make a reasonable guess at how much, then they have to create what's called a provision. It's essentially booking a liability for a future payment where the exact timing or amount isn't set in stone yet.
And the accountants have a pretty clear flowchart for this. If paying out money is probable, in an accounting speak, that means more than a 50% chance, then you have to create that provision on your books. If it's only possible, so less than 50%, you don't book the liability, but you absolutely have to mention it in the notes so investors know it's up. And if the chance is remote, well, then you just do nothing. Simple as that. So there you have it. We've gone over some of the big rules and the main building blocks. And once all that accounting magic happens, you get the final scorecard, the financial statements. But honestly, just looking at a page full of raw numbers can make your eyes glaze over. The real magic, the real skill, is turning all that data into actual insight. And that, my friends, is where financial ratios come into the picture. They are just incredibly powerful tools. They let you take two different numbers from the statements, put them together, and suddenly you can see trends, you can see how you stack up against the competition, you can finally start to understand the story the numbers have been trying to tell you all along.
So let's check back in with Explainer Co. one last time. Let's say we do the math and we find out they have a price-to-earnings ratio. We call it a PE ratio of 25. Okay, a PE of 25. What on earth does that actually mean?
Well, what it's telling you is that the stock market is willing to pay $25 for every single dollar of that company's profit. A high PE like that is usually a sign of strong confidence from investors. It's a big signal that they're betting on the company's profits to grow and grow a lot in the future.
Okay, let's look at one more, another really important one for investors, dividend cover. And for Explainer Co., let's say it's 2 times. So again, what's the story here?
This number is all about safety and sustainability. It means that Explainer Co. earned twice as much money as it paid out to its shareholders in dividends. That's great news. It suggests that, 1, the dividend is pretty safe and they can afford to keep paying it. And 2, and this is just as important, it means they're keeping the other half of the profits to plow back into the business to fuel future growth. So you see, at the end of the day, financial reporting is so much more than just ticking boxes for compliance. It's a story, a whole narrative, just written in the language of numbers. And whether you're searching for signs of explosive growth, or steady stability, or hidden risk, or a golden opportunity, trust me, the story is in there. The only question is, what story are you looking for?